Hi students. We're going to conclude our section on leasing with two examples of leasing from the perspective of the lessor. So the first thing we need to look at is the idea that there are two general types of lessors. There is a company that just does this as a business, and you could go to a leasing company and say, I want to lease this airplane, and they'll just go buy an airplane and lease it to you. So they're not necessarily making any profit when they buy that airplane and lease it back to you. Their profit is the interest that they earn on that item when you sign the lease. So that kind of lease from the perspective of the lessor is here. It's called a financing type lease because all they really do is finance that airplane for you. Now, the other kind of lessor that you're probably actually more familiar with on a personal perspective is a sales type lease, and we call that either a manufacturer / dealer or sales type lease. And in this type of lease, the manufacturer of the product is trying to promote sales. So they set up a leasing arm of their business so that customers have the option to lease and not just purchase. So when we do a sales type lease, it does involve a profit to the dealer because, if you think of a car sale or something like that, if you lease it, the dealer makes a profit. They're essentially selling you that car at full price, probably, and then not paying that much to the manufacturer, right? So we're going to do an example of each one, but let's just look at a little more detail of how we do these before we move on to our example. So when we're looking at the dealer or sales type lease, of course, they own this item already. Essentially, it could be inventory. Maybe expensive inventory like a vehicle or equipment, but it's still a type of inventory. And they replace their investment in that inventory or asset with a lease receivable account. So now you owe them money. We basically, give the lessee the asset and accrue a lease receivable. So the lessor has a lease receivable and the lessee has a lease liability. Now, over the term of the lease, two things happen. The lessee is paying for their use of that item, but they're also paying interest. So we have another term here called net investment in the lease, and that is your lease receivable less unearned interest income. So I'm just going to note here, just think of it this way. If we had 4 payments of $25,000, then our lease receivable would be $100,000. Of that $100,000, part of it is to pay for the item and part of it is interest. So if we just said, let's say over the term of the lease, we're going to earn $25,000 of interest, then we would say, well, we have the net investment is the payments we're going to receive in full, less the unearned interest income at inception of the lease. It's all unearned. That means our net investment would be $75,000. So this is quite different from accounting for a financing type lease. So let's look at a financing type lease. Here, we're looking at some of the same concepts. We have lease payments receivable, also sometimes called the gross investment in the lease. And the lease payments receivable are the total payments for the lease plus a residual value or bargain purchase option if there is one. So essentially, this is what the lessor will receive. They will receive all of the lease payments plus any remaining value in the leased asset, or they'll receive money when the lessee buys it. So this is your lease receivable. And the same thing as before, the net investment in the lease is the lease receivable less unearned interest income. So the difference here is that in this financing lease, they're not selling you inventory, they're going out and buying that asset simply to lease it back to you. So our first example is going to be a finance type lease, financing, I should say. Now this is the same lease that we did before, except now we're going to look at it from the perspective of the lessor. So if this is familiar to you from a previous video, that's good. It's the same lease. So basically we did have payments of $25,982 that included $2,000 of maintenance that the lessee is paying. So only $23,982 applies to the lease. No residual value, no renewal option, and the rate is 10%. So again, this lease amortization schedule may be looking a little bit familiar. It's essentially the same one, except I put in dollars and cents this time. So here we know that we have the beginning value of the lease. First payment reduces that right away, and then year by year, they're going to be earning interest. Now remember, this is from the perspective of the lessor, so this will be interest income, not interest expense. So let's look at the journal entries for this. Now to begin with, we're buying this equipment in order to lease it. So our first journal entry for a financing type lease is simply equipment acquired for lessee, cash. And you'll notice this is our asset right here. Now the first thing we do then essentially is hand over that asset to the lessee. So here is the credit, removing that asset from our books. Now what's the 19,908? Well, the 19,908 is all the interest you're going to earn. So if you take all of the lease payments, remember, take away that 2,000. So if you take 23,981.62 times 5 lease payments, you're going to receive 119,908. So that becomes your lease receivable. And of that amount, 100,000 is the asset and 19,908 is interest that you will earn over the next few years. So this is how we set up our lease to begin with. Now, when we get our money, remember, the very first thing that happens is day one, we receive the first lease payment. So our lease receivable goes down. Now, I wouldn't worry too much about this. Remember, there was $2,000 for maintenance and repair expense. So all this is doing is implying that we paid it ourselves already, debited maintenance and repairs expense, and now we're going to credit it so it zeroes out. So that's just kind of a place to put that 2,000. We don't really know how a company might do that. So our lease goes down by $23,982. And after that, every December 31, we're going to accrue interest income according to our table. And you'll notice this is 7602, so I just want to show you that table again for a moment. Here's the table, and here is our 7602, which represents interest earned for 1 year. So we reduce unearned interest income and we credit interest income. Now I haven't done every journal entry for this lease because these entries just repeat every single year until the lease is over. And remember, there's no residual value here. So every year they give you the money, and every year you accrue your interest income. So what does this look like on your statement of financial position? Well, the current asset from the net investment in the lease, remember this is the December 31 statement, on January 1 you're going to get your $23,982. So your current asset is $23,982, and the long-term asset is the balance of that net investment in lease. So this is essentially the rest of what you're going to get. Okay, so that's all there is to it, really, for the lessor accounting for a financing type lease.